Welcome to today's market report.
European stocks ended a volatile session lower on Friday as investors digested data showing slowing jobs growth in the United States, but they still marked their best week in 2 months as fears of soaring inflation were tempered. A U.S. Labor Department report showed non-farm payrolls increased by 194,000 jobs last month, compared with an expectations of 500,000. Although the headline number was a huge miss, analysts said excluding the seasonally adjusted factors, the number was not too disappointing. The Pan-European Stoxx 600 index, which had fallen as much as 0.5%, only briefly reversed the earlier losses after the data. Payrolls data came in weaker than expected, but the overall trend of an improving labor market remains intact, according to Wells Fargo. While strong numbers could cement the case for the U.S. Federal Reserve's withdrawal of its support for the economy, many analysts expect that even a second straight week employment report may not be enough to hold back the central bank from announcing a slowdown of its bond purchases later this year. It doesn't look like today's figure comes anywhere close to the kind of scary figure that might provoke the Fed into swerving course at the last minute, according to IG. Oil and auto stocks led gains in Europe, but this was outweighed by tech stocks falling 1.4% as rising bond yields deemed the high growth sector's appeal. The Stoxx 600 rose 1% on the week as relief over a temporary lifting of the US debt ceiling and as easing fears of an energy crunch calmed rallying oil and gas prices, which had triggered inflation worries. UK travel stocks, including British Airways on a IAG, Whitbread and Ryanair, gained between 0.4% and 1.6%, with Britain set to scrap tough COVID-19 quarantine requirements for 47 destinations. Czech trucking services firm Eurowag fell 10% in its London market debut after floating a day late and at a cut price. Auto stocks rose 1.3%, rebounding from a sell-off in September on concerns about supply chain bottlenecks and chip shortages hitting production. German car maker Daimler rose 2.6% as UBS upgraded its stock to buy from neutral and hiked its price target to €100 from €79. Crude oil WTI was up 1.63% at $79.58 per barrel. Brent was up 0.72% at $82.54 per barrel. Gold futures was down 0.11% at $1,757.25 per ounce. On the FX front, the British pound has found support at 136.10 after having hit resistance at 1 week highs of 136.60 earlier today. The pair consolidates above 136 after a significant recovery from year-to-date lows near 134 last week. The sterling appreciated across the board this week as market expectations of a BOE hike next year have offset investors' concerns about the fuel shortages and supply disruptions that pushed the GBP top midterm lows last week. Market sources are anticipating the possibility of Bank of England leading the rest of the world's major central banks to start raising interest rates in order to tackle inflation pressure. In that case, the market is pricing the first interest rate hike next February. Furthermore, the widely awaited US non-farm payrolls report has disappointed, showing a 194,000 increase in employment, well below market expectations of 500,000 new jobs. The dollar retreated immediately after the release to pair losses shortly after, as the market assumed that these figures would not change Fed's plan to start tapering bond purchases over the next month. According to Westpac, a more hawkish stance by the BOE is likely to support a long-term upside circle, sending the pair towards 141. Its fuel shortage notwithstanding, the UK is expected to experience a robust recovery in GDP back to near the potential GDP level that would have been seen had the pandemic not occurred, as well as sustained inflation at or above target over the entire forecast period. As a result, the BOE is expected to tighten in line or just ahead of the FOMC. The euro-dollar rises above Thursday's daily highs, trading at 115.72.
This is today's market news. Thanks for listening. We'll see you next time.